when you're investing in private markets, you're investing, not trading. So you got to have an investor's mindset, not a trader's mindset. Investing in the right part of the public markets can give you just as much upside as investing in private markets without the illiquidity. But if you're going to invest in private markets, you've got to get compensated for that illiquidity, right?
Hey everybody, welcome back to Break Free from Wall Street, the show where we explore how investors can move beyond stocks, bonds, mutual funds, those public markets, and learn how real capital is being deployed in alternative assets. As we talked about last week, we're really starting our dive into this with private equity and venture capital, and we're really fortunate to be able to have with us today as a guest Seth, not Levine, Levine. And he is an expert, a venture capitalist who has tons of experience. We're really looking forward to pick your brain today. Seth, welcome to the show, first of all, and it is great to meet you today. Tell us a little bit about yourself. Tell us about your background and how you ended up in the venture capitalist world.
Nick, thanks for having me, and thanks for what you're doing. Right, I think sometimes, venture. I've been in venture capital for 25 years, and I think it's
Wow.
less mysterious now than it used to be,
Mm.
because there's a lot of people that write about it, and there's relatively well-known VCs now. But it's always been kind of a goal of mine to demystify the asset class, right? I mean, not just to other potential, investors, but also to entrepreneurs, et cetera. So I love it. I think the more people know about sort of how capital flows across and in our economy, the better off we are. So I appreciate that very much. So I guess I'm a capitalist by training and predilection. As I mentioned, I've been a VC for 25 years. I had a very brief stint of work before that. I worked on Wall Street for a couple of years for a large bulge bracket firm in there doing telecom, mostly junk bond, high yield debt. Sorry, is what we call it. But doing mostly that, some equity stuff, things like that, some M&A as well. And then I had a short, sort of like 5-year operational sort of stint where I did corporate development, a lot of M&A. Eventually, actually got into management. I ran a pretty large business for. We took a company public in the bubble. I kind of ran that process. And then then once we were public, I ended up operating, I don't know, about a $55 million piece of that public company, and had a couple hundred people reporting to me. So that's like my operations experience. But then I jumped into venture capital. It's funny, at the time, Nick, I took a job I was an associate job. It was like a big step back actually from what I had been doing, but I was curious about venture and I wanted to try to get into it. Um, and I took it with a 2-year sort of contract, right? I was going to stay for 2 years, and then it was like a 2-year associate program. And then I was going to move on. It was SoftBank Venture Capital, which was a Palo Alto based venture firm that was loosely affiliated with SoftBank Corporation in Japan. 2 years turned into three turned into four. I got promoted to be this like super junior partner there. And then I actually almost left. I actually went to my partner at Foundry. One of my partners at Foundry is a guy named Brad Feld. Some of your listeners will be familiar with his work. He's written a number of books,
Mm.
and he's very well known in the venture industry. And I went to Brad and said, "Hey, I'm not quitting today, but I'm not going to stay. I'm a junior partner here." By then I was married. We had 2 kids. Like I was like, time to move on. And Brad, in a conversation that changed my life, said, "I actually don't think we're going to be able to raise this next fund. Thinking about doing something outside of SoftBank had changed its name, Mobius, outside of Mobius. Um, would love to do it with you. What do you think?" And we started talking about that. We eventually invited 2 of our partners from Mobius who were in California to come move to Colorado, where both Brad and I were. And we started Foundry in 2000. They moved in the summer of 2006. We started Foundry in 2007. And since then, we've raised about $4 billion to deploy specifically into early stage businesses and into other venture funds. So we have a portfolio, a institutional portfolio of about 50 venture funds, and then I don't know, maybe 100 companies now active in the portfolio, something like that. And then in addition to that, my partners and I have done a little bit of private investing. The fund to funds investing came out of our experience as just personal investors in funds. So I personally have exposure to, I don't know, another 50 or 70 funds that we've invested in over the last, 20 years or so. So it's been an interesting ride. And I should mention, Foundry has raised our last fund. We raised a fund in 2022,
Mm.
and we decided, at that time, we announced it a couple months later, that we weren't going to raise any more funds. Just we can talk about the challenges if you want about sort of an institutional firm, but Foundry was so tied to the
Sure.
core partners. One of us had already retired, and we just were like, you know what, we're good. I think everyone who's we have there's 6 of us now at the firm. Everyone's going to go do something ish after this, but it's not going to be on the Foundry platform, which is kind of fun. It's a good position to be in.
Yeah, and just on your background and your journey, I mean, I think it's so incredible that everything that has been built up to this date was really you can track back to taking a step into something that may have been uncomfortable at the time, something that was totally new, something that was different from what you're doing before, and you really gave yourself an opportunity not only to build everything you've built, but to put yourself in a position where you have this incredible knowledge and experience. So that's I think something that we can really tie back to a lot of our listeners who may not be, in the alternative asset scene at all. Maybe they are just in the public markets,
Mm.
stocks, bonds, mutual funds, just doing what they've understood is the trajectory for most people. And one step, one small change or one small decision can really ripple into you having a lot of knowledge and a lot of experience, and in a lot of cases can really be the stepping stone for you to create generational wealth for yourself.
Yeah, it worked out. I'm not living the life I thought I would live, right? I think it is. I sometimes I think about, like, my grandfather on my dad's side didn't finish high school, right? He quit
Mm.
high school to go work. His wife, my grandmother, actually went to college, was a little unusual for people that age. My dad has a PhD, right? Like, it's like with this the thing I love about the time we live in, the country we live in, et cetera. It's like it gives you this opportunity. Um, and I grew up, I remember when my dad initially was a professor, which is, especially back then, was not a good way to make money. I remember him counting bus pass,
Mm.
right? Like bus fares.
Yeah.
It was 25 cents at the time. And and then eventually he got into computers, and we had much more of a like upper middle class life, growing up than initially. But I remember when it was very much like kind of month to month, week to week, when I was a younger kid, and you go from that to, the risk that we took, by the way, to start when we started Foundry. It was more expensive than it is today. We had to write like a big offering document and a bunch of things.
Mm.
That was for me an all in moment, like all my chips on the table. Everything
Yeah.
I had not saved a lot of money at that point because I sort of the bubble had come and then gone, and I'd made some money, but not 7 figures of money, and put it all on the table for Foundry. And on top of that, sort of going back to 2007, in May of 2007, we'd gotten, you get no's before you get yeses, and we'd gotten a lot of no's when we were trying to fundraise. And what we were trying to do was not, we weren't in Silicon Valley or Boston. And at the
Sure.
time, that's where all the funds were. And we were these like 4 guys. Brad had a track record, Ryan sort of had one, and Jason and I really didn't. And in May, it looked like we weren't gonna get the fundraise, and so much so I actually came home and one night talked to my wife about it, was like, "Hey, I don't think it's happening." Right? And by the way, I think I
Mm.
basically lost the life savings, right? And so, um, I think that with great risk comes real reward, and obviously it worked out pretty well for me in the end. Um,
For
but
sure.
it was not, I think sometimes people sort of forget about the struggle part of it, and if you're familiar with the venture industry, Foundry is very well known. My firm is very well known. And I think people just sort of assume, like, it just sort of, like, happened into being and it was always
Just
successful.
materialize. Yeah.
Yeah, and it totally wasn't. We worked really hard both to get it off the ground, and it looked like it wasn't gonna happen, and it was, again, for me, all chips in the middle of the table kind of moment, and, so I feel like obviously it paid off. I'm glad I took the risk, but, we, meaning both my partners and I, but also my wife and I, needed to be willing to take that risk, right? And I feel like we're constantly making these sort of risk reward calculations in our lives, in our investment lives, in our work lives, et cetera. and just flagging that, is exactly the same for me. And that was, again, this is 2007. That's not even 20 years ago now.
Yeah, that's crazy. I mean, and just to piggyback off that, you really, like you said, you make those calculations in your head, and you say, okay, before I do X, I got to figure out, Y and Z, but I also got to make sure that this is lined up, and it feels like we have to in our heads justify the ability for us to take this risk. Do you feel like there was a point that you got to where you had to shut that part of your brain off, or just say, look, I don't have everything lined up perfect, but this is what I'm gonna do, and I'm gonna do it to the best of my ability.
I would say it a little bit differently, Nick, and this is for me specifically. I don't think my brain works exactly in that way. And I think that
Sure.
that's both a real positive, but also potentially a real negative. I guess that's true for everything. Like, your superpower is also your greatest weakness. Like,
Mm,
I I will often leap or take risk without that, like, very, like, charting all of the pros and cons, which is interesting because I'm a relatively deliberate person just in general, but that's not how I've approached risk, and that's not even really how I thought about, like, starting Foundry, for example, and it's definitely not how I think about when I make a new investment, for example, in a company. Of course, I think about what's the potential upside? What do I need to believe? That's the question we often ask ourselves. What do you need to believe for this to be $1 billion business? Um, but so I definitely ask those questions, but at least when we started Foundry, I wasn't thinking, "Okay, I'm gonna stake all of my net worth, but here's what I think it could be worth on the backside." I I thought at the time that it was something I was really interested in, that I really wanted to do. I feel like this when I invest in other funds, for example, certainly with my personal money, right? It's a little bit more tidy and buttoned up in our institutionalized portfolio. But like, is this someone I want to back? Is this someone 10 years from now that I want to be able to pick up the phone and call or go out and have a beer with, regardless of whether we end up making money together or not? And I've been willing to do that over and over again, and I'm sometimes wrong in terms of the making money part. Occasionally, I'm wrong on the go get a beer part, but mostly not. Um, but I'm right enough that it's been a successful way to grow wealth, right? And obviously at Foundry, that's been the case as well.
that's awesome. So yeah, I mean, it's not like you're hitting home run runs every time, but you're right enough of percentage of the time for it to make sense and for it to work, and it obviously has worked very well.
There's
I
a
love
great book
that.
called Thinking Fast and Slow, and it sort of like talks about this two-tier sort of rationalization or decision making sort of functions that you have in your brain, and one's the sort of quick, the blink style. There's another book
Mhm.
called Blink that talks about this as well. A blink style, like what's just your gut instinct, and then the other is the much deeper, do the analysis, like really spend time on it. They both have time and place, right? And it's not that I never make decisions where I really like go through a long analysis, especially if there's a lot to analyze. But in particular in early stage investing, a lot of it relies on sort of pattern recognition and gut instinct, right? And I think that
Mm,
um and that may be a little bit different for some of your listeners who are used to trading in publics where there's a lot of information. On the
right.
private side, there's that's not that, right? And you're truly chasing alpha, like real alpha, right? Not public market alpha. Um, and sometimes you just kind of have to be willing to take the leap to do that.
That's incredible. And I feel like you're in a very unique position where, like you said, you do have that experience in those public markets. What what have you seen in your experience in the private markets that you didn't necessarily see in the public markets? Um, and that's a kind of open question, but that can be an opportunity or in returns or even in structure.
Well, there's a couple things. So one is that in the public markets, I would differentiate between being a trader and an investor, right? If you're
Mm,
an investor, you're picking longer term trends that you're interested in, and you want to stay in a company for a while. That tends to be, I don't do a lot of public market investing just because I've got such a high risk portfolio that's like super weighted still to privates. So I tend to be more in fixed income and things like that. But I do have a decent sized public markets portfolio as well. And I personally tend to be more of the investor style. Now, there's another style of investing, which is the trading style. Nothing wrong with that. Lots of people do it. I've got tons of friends that are traders. I'm assuming a bunch of your listeners are also traders. The reason I'm differentiating is when you're investing in private markets, you're investing, not trading. Right. So you got to have an investor's mindset, not a trader's mindset, which is you're going to be holding it for a while. And when you invest in a venture fund, you're locked up for a while, right? So you better be getting paid for that illiquidity, which is why venture historically as an asset class has returned better, let's say, than at least the markets as a whole. Although I think there's some arguments that are worth kind of digging into at some point about investing in the right part of the public markets can give you just as much upside as investing in private markets without the illiquidity. But if you're going to invest in private markets, you've got to get compensated for that illiquidity, right? And that means you need to be thinking like an investor because you are holding for typically periods. I mean, the time to get your money back in a venture or private equity fund is between 7 and 10 years. That's to get one extra money back. So to get your
Mhm.
basis back, right? And then the upside from there. Now, when it works, it can be incredibly powerful, right? It's worked at Foundry. And Andreessen recently just put out some of their numbers, and they were amazing, right? They look really, really good. Um, and so when it works really, really well. But you need to be thinking like an investor, not a trader. And so I'm drawing that distinction because I think sometimes people misunderstand because there's so much risk in the private markets. They think they're traders, but they're not. You're investors. You're just investors with with a higher need for return because you have a longer hold periods and illiquidity.
Right. And and to kind of throw this in there too, to go off what you said, a lot of our listeners are looking at utilizing their retirement capital
Yeah,
to invest in these alternative assets. And yeah,
love
I
it.
know you did mention longer hold periods. The great thing I think about these, these retirement plans is they're really geared towards these more patient uh assets where there is maybe a longer hold period, but with your retirement funds, I mean, a lot of these are already locked up until you're of retirement age and you have that time to be able to let the investment mature. Do you see any other really pros for that retirement capital going into a fund like yours or other funds where maybe it's not only the advantages of having that money that's not going anywhere, right, or can't go anywhere, that is already seemingly locked up, but is there any other advantages that you would see of using retirement capital?
Yeah, I think a lot of people are much think about how an endowment is managed, right? There's no or very few endowments in the country that don't have alternative assets, right? Private market assets. And they do that because you're trying to because they're long-term capital, right? In that case, they're perpetual capital, but they're seeking return and they're seeking balance in their portfolio. And I think a lot of people in their retirement accounts don't seek enough risk. Right? I'm an endurance athlete, and we often talk in endurance that like the real challenge is that most people don't train hard enough on the hard days and easy enough on the easy days, right? And I think that that's true in
Mm.
investment portfolios, or an equivalency is true, right? Where you're taking risk, you're not taking enough risk, right? And when you're trying to not take risk, you're probably still taking too much risk, right? Like you need to decide what this dollar is supposed to do for you. If it's supposed to be a risk dollar, then it should be placed in assets that have real risk to them and because of that real
Mm.
upside, right? So that definitely doesn't mean go buy one venture fund or one private equity fund. That means to say, hey, I'm going to have an allocation in my portfolio. And again, your retirement assets are a great portfolio to do this in. The exact percentage that you put into alternatives probably not probably will vary based on whether you're 10 years from retirement, in which case you probably want to start getting out of alternatives, or you're 20
Right.
years from retirement, or you're 40 years from retirement, right? Like then you should be taking all sorts of risk because the markets over time tend to correct up. And so your allocation will depend on that. But when you then decide what that allocation is, you should go for multiple funds. And one of the things that I appreciate about sort of the world these days, and I think we should be doing more and more of this, is there are a lot of funds available on these RIA platforms now. And so there is the opportunity as an individual investor to invest in more private funds. I wish we would get rid of more the accredited investor rules, or at least change them more, to allow more people to access private markets. There was a joke. I don't know if it's still a joke, but I remember this when I was, in my 20s, and we'd sort of be like, how do you become a millionaire? And the joke was, how do you make $1 million? Well, you start with $1 million, right? Like, it's easy to make your second million, easier to make your second million than your first million,
When you've already
because
got the first, right?
so much more opens up to you, right? And it's just like you have opportunities to do so much more. And I think that I personally don't believe that should be restricted just to people who are accredited investors, which is a investment threshold. Probably everyone knows who's listening what that is, but it's you have to have a certain net worth, or a certain income level, either individually or you with your spouse. And I guess it's intended to sort of make sure people don't get cheated who are, like, unsophisticated, but I really feel like that's just this incredibly, like, paternalistic view of government that, like, it's gotta be there to save us. Like, of course, fraud is fraud, and there should be some
Right.
safeguards and disclosures and things like that, that are required, but I would love to see more and more people have access to, all sorts of different investments. Here, we're talking about fund level private investments, but even company level private investments as well.
Yeah, I think that's a great point. It's already, I feel like, like you kind of mentioned at the beginning of this call, this kind of like mystified thing, venture capital, even private equity in a lot of cases, and it not only do you have some of those hurdles where you have the accredited investor regulations and rules that some funds will have in place, but even just the idea, I think of venture capital and private equity, often paints a picture that it is only for, maybe institutions or the ultra wealthy. From your experience, do you think that where do you think that everyday investors misunderstand maybe how that is painted?
Yeah, I mean, I think that's really important. So I think everyday investors have this idea that venture or private equity is interesting, right? And maybe because it's
Mm,
behind the walled garden, it makes it more interesting. I think the thing to be careful about is making sure your allocation is correct. And one of the things, again, I love about the idea of putting retirement assets is, and I'm asterisk here, I understand there are ways that you can access for hardship and other reasons retirement assets. But generally speaking, people are in the mindset that I'm 30 years old. I don't even get access to this for 35 years, right? It's not I'm not taking money that I might use to buy a house in 3 years and putting it in some asset that, oh crap, I can't get out of it now, right? And then that's the place I think people get in trouble, where they don't match the time horizon with the liquidity horizon. And I think that a lot of that goes away when you're investing out of a retirement account. Now, I wouldn't put all my, 100% of my retirement account in funds, right? In private equity or venture. That's probably more risk than makes sense. But I think that mapping of risk and time frame is really important. So if you are listening to this and thinking like, well, I don't either have enough in my retirement account, and by the way, you should be maxing your retirement account literally every year. It's the first thing we taught our kids was like, and we
mm,
actually got the Roth IRAs when they were relatively young
there
because
you
it's like,
go.
let's just get going, guys. Um, and I was given that same advice my first year, even though I had very little money. First year out of college, I had very little money, and someone ran a spreadsheet for me. It was like, you are putting every dollar you can in. We will figure this out. Um, but if you are thinking about using some money that's not in a retirement account, so money that you in theory could use to buy a home or invest in some other asset, like, you need to be thoughtful and careful about how do you allocate money to privates? How much do you allocate to privates, right? And privates draw down over a couple of years, so you got to like plan that out a little bit, and be careful you don't get sort of over allocated, um, and too much unfunded, which is what we'd call that. And then pick a strategy and then execute the strategy. And if part of your strategy is I like day trading and I'm gonna have 10% of my portfolio in day trading, great. Like that's 10%. And if part of your strategy
Mm.
is, hey, I'm gonna buy a house in 2 years, I need some money that's super low risk. I don't know, treasuries are paying okay these days. Like put that money in treasuries because I know I need $100,000 for a down payment. Like be thoughtful and methodical about that piece of it. And then if you got a bunch left over and you're like, hey, I'm very clear I don't need this money in the short term and I want to go do some interesting things with it. Awesome. Then develop a strategy which potentially and probably should include some alternatives and go invest in that, right?
Yeah.
And
And
if
it's
the
the way that
markets
you
go up and
s
down, you don't
yeah.
like stray from the plan, right? I mean, you evaluate you evaluate where things are, and then you make a decision based on that, right? You don't freak out.
Exactly, and it's because you have access to both sides of the coin here that you can structure something, based on what the market looks like or what your personal financial situation is. And I think if you can tailor that, like you said, that's really really powerful.
Nick, one more thing I
Historically,
want to add,
yeah, yeah,
that's I think really important. If you decide to get into alternatives, you decide to get into venture or private equity, the answer isn't to say, I have $100, I'm going to put it in this year.
mm,
You want to time diversify when you get in. So if you got $100 to invest in venture capital, you might split it up and say, hey, I'm going to invest it over the next 4 or 5 years because you want time diversity. We call it vintage diversification, right? There are some really good vintages in venture, and there's some really not good vintages. And not good vintages in venture, right? If you're in the wrong year, you can lose money. Um, and so,
mm,
generally speaking, I mean, I guess you could have a view about, hey, it's a good vintage or a bad vintage, but you don't. I mean, hindsight's 20/20. You don't really know until you're done. So you're probably better off to feather that money in over a period of time. You don't want to just in the same way that you wouldn't say, I've got $100, I'm going to put it all in, you know, Nick Nick.vc, right? You want to spread
right.
it around amongst a couple of funds, and you want to spread it around amongst a couple of vintages, a couple of years.
Okay, so it's not you're not pushing all the chips in at once. You're not
No.
even saying, okay, here's 50% of my retirement all into VC. Interesting. I like that.
Yeah, and in that way, it's
Um,
different than investing in public markets, because when you're investing in public
mm,
markets, you're like, "Hey, I believe that this is a trend and, whatever, Microsoft will be the beneficiary. I've got $1,000, I'm gonna invest into Microsoft." And you're not like, "Oh, I'm gonna invest $100 today and $100 tomorrow and, for the next 10 days or whatever." Like, you just put it in. That's not how it works or not how it should work in venture. You should pick your dollar amount that you wanna allocate, divide it up into a couple of funds, at least I'd say 3 funds, ideally at least 4, and then I would feather it in over a handful of years.
is there any way to know what a good time frame is? Is it based on how much capital you have of how you would spread that out over time?
Well, and you can anticipate. I mean, what happens when you invest in a venture fund, so if I and this may not be true for every listener, because a lot of funds, if you're investing in them and you're a relatively small dollar investor, you have to put all the money in at the time
Sure.
of your commitment. Sometimes, or if you're a larger investor, you can invest. You get these capital calls, and you invest over a period of a couple years. So you got to understand how that works and manage that, right? Because you might have some committed capital that's not yet called. Um, but but that is how it works, right? You make a commitment and you put some amount of that in as it's called initially, and that could be 100% again, depending on how the rules work for that RIA platform. Um, and then and then you got it. Then you make a decision on another fund, and then another fund, another fund. There's no way to know. I mean, obviously, when you're inside the industry, sometimes you have a sense for whether things feel like they're a little overheated, and valuations are too high. And I think
Mm.
if you'd asked me in 2021, like, do I think that that was gonna be a good vintage? I not only would I have said no, I did say no at the time. Um, but, so, there's a little bit of that, but overall, generally, I would say don't try to time the market. Like, if you decide you wanna allocate to it, by the way, now I think is a pretty good time to be investing, so I wouldn't be encouraging people to not invest right now anyway. Um,
Mhm.
but, but I would make sure you put it in over several years. Clearly, I think this is
Awesome.
important because I've hammered the point.
No, I love that. I love that we're being thorough. One thing I was thinking when we were talking about individual investors, because historically, as I understand it, it has been these private deals were reserved for institutions, family offices. I know that more personal investors are getting into private equity. It is becoming more common for venture capital also to see individual investors. Tell us from your side as a partner in a venture capital fund, what are you actually seeing? What dollars are you actually seeing being invested into your funds today?
Yeah, so Foundry maybe a little bit different in the sense that we've been doing it for a long time. The vast majority of our investors are very large institutions, pension
Mm,
funds, endowments, things like that. But that said, across the industry, we're seeing a lot more, especially new emerging managers, so newer funds, and there's lots of alpha in new funds, right? There's lots of, and there's variability in that. But a lot of those funds are putting their wares up on these platforms and allowing individual investors to invest. And again, as I said earlier, I love that we're getting outside of just really wealthy people, family offices, institutions. So I think that that's a trend. I think it's a trend that's here to stay, right? I mean, someone, JP Morgan was telling me, I can't remember what the number was. It was some huge number that they had placed into alternative assets, credit funds, venture funds, private equity funds, over the last 12 months, through their RIA platform, right? Which is great. And by the way, there are
mm.
a couple of public PE funds, right? KKR, a couple of others. So you can also access it through the public markets if you want to.
For sure, yeah. Yeah, and when you're looking at those funds in the public market and funds that are maybe available on the private market, um, let's say let's take it back to that example where you say I have $100. What considerations go into accessing this fund in the public market versus a fund in the private market?
Yeah. So I think as you have access to funds, you'll get a bunch of information about the funds. I would start with just like, what sounds interesting to you, right? Like one of
Mm,
the reasons, like you invest in privates because you want to make money and you want to get higher return in return for your lockups for the illiquidity. But for me, part of it is just I want to back interesting people doing interesting things. I want to be able to talk at a cocktail party and say, oh, yeah, no, I'm in a fund that's doing this really cool new thing in X. And X for you might be around, I don't know, manufacturing electronics. And for me, it might be around, biotech. I mean, so I'd start with like, what's interesting. Right. And I think that, I mean, yeah, I get it. Right. I mean, everyone's like, oh, how can you make money? Well, AI looks like a great place to make money now. You can do a little bit of that, I guess. But I feel like the more interesting thing is like, what are you personally passionate about? Because that'll also
no.
give you when you actually start reading into the documentation, you hear about their thesis, what the background of the fund managers, the general partners. It'll give you a better ability to discern whether though that's a good bet or not a good bet. And so I always tell people to start with that, right? Like start with areas that you actually have a personal interest in because it'll make it more fun and exciting for you, and also you'll do a better job with that. So I'd start with that, and then I'd read about the backgrounds of the fund managers, read a lot about their thesis, right? These are the things that we do as an institutional investor and say, okay, are these people uniquely positioned to take advantage of this opportunity? Do we think this opportunity, as they've outlined it, is a really interesting opportunity? And I mean, there is all over the map the types of things that people are trying to do. And there's not just one style of fund. As I mentioned, there's credit funds, right, that invest in debt. There's funds that invest only in, operating businesses that have cash flow that are like, solo owners. There's more traditional venture. There's venture at the very, very earliest stages. There's venture at, all sorts of different stages across a company's growth curve, right? So there's all of those things are worth looking into and deciding, um, based on your interest and where you get excited, like, does this team match to this strategy, and does that strategy match to my worldview of where I think, there will be opportunities?
Yeah, I love that, and the first, I feel like, investing advice that I ever got was invest in what you know, and I feel like that really goes hand in hand with invest in
Yeah.
what you're passionate about, and I love that that
Buffett,
that
right? That's
that
what he
not
always used to
yeah,
say, right? He
mhm.
invested in the limited, I think was the famous example because he was like, "God, my" this is ages ago in the '80s, I think, but he was like, "My wife and all her friends are shopping there. Like, what's going on here? I should maybe look into that."
Yeah, absolutely. So when we're looking at venture capital as this alternative asset, what do you think is more of the barrier that's keeping people from breaking into venture capital? Do you think it's more of a lack of education, lack of interest? What do you think is keeping people and investors more specifically stuck on those Wall Street products?
Yeah, I mean, I really think it's access, right? I mean, the problem, and
Mm.
I've thrown out the RIA term a couple of times. Those are these platforms, but you still probably need to be a private banking client at a lot of firms to get access to those, right? Now, there are some sort of quasi-public platforms where people um, can invest directly in companies or invest directly in funds. But I think, Nick, that's the biggest challenge. I'd like to see more available, and I wish more of these platforms would make them available to sort of retail investors outside of the private bank, right? I mean, I'm thinking about the conversation I had with JP Morgan. I was with a private banker, right? And I didn't ask him,
Mm.
hey, if I mean, I don't need access to that, so we weren't talking about like my investing in it, but I didn't ask him, "Hey, if I wasn't a client of the private bank, if I just was like a Chase, account holder, could I get access to that stuff?" And so, I wanna see more of that because I feel like that I don't get back to my, the best way to make $1 million, start with $1 million. Like, I don't want that to be the case. I really want people to have the ability to make real decisions with their own money, have agency, and decide that they want to invest. But I think the biggest impediment is actually having access. And I think if your listeners are not a part of a private bank, they're going to have to do a little bit more work to like figure out how can I get access to funds. And I want access to funds that are good funds, right? So I can't just go to the sort of lowest common denominator. This is the last place someone raises money. You want to be on a platform, and it is becoming much more normalized for funds to have an allocation to an RIA or multiple RIAs. Um, but um, but it's going to take a little bit more work, and I would love to see
Yeah.
that get fixed.
Yeah, absolutely. And one thing that we do for our clients is give them access to their retirement capital, create those structures for them to be able to not only deploy their retirement funds into alternative assets, but to have direct control over it. So they're not, waiting on that, custodian approval. They're not waiting on the process. So that's something that we do a lot of the time for our clients, but we still have those barriers, I feel like, in a lot of cases. And if those barriers just fun imagination time. If those barriers disappeared tomorrow, how much would that change your fundraising velocity
Yeah,
if
I
it
mean,
just completely opened up?
let me abstract it to the industry because just we've got such long-term investors at Foundry. Our fundraisers have
Sure.
been very much going back to our existing investors. But I absolutely think that would be transformative to the industry. And I think in particular, it would allow newer, uh, these newer general partners or newer partners at venture funds, newer funds to raise capital. Um, and I think and also GPs from different backgrounds to raise capital, right? I mean, I think there is the traditional limited partner, the traditional investor in venture funds are actually not particularly risk seekers, right? They are asset allocators. And so that has tended to narrow the type of fund that they're interested in because there's pattern matching to things from 20, 30, and 40 years ago. And that means that actually change in the venture industry itself is hampered. And I think that some of that will go away when retail investors can make their own decisions about what they want to invest in.
Right. And I feel like that's one barrier that we've talked about. I feel like another barrier is many investors do want the exposure to these private assets, but I feel like maybe worry that they're going to be doing it in the wrong way, especially within retirement accounts is what I see more personally. But I think just in general, people just have this worry that they don't know how to do it, they don't know how to structure it. What are some common mistakes that you have seen when investors try to participate in these private deals?
Yeah, so there is a little bit of education that needs to happen so they understand what they're doing, right? Which is why I was excited to come on this podcast and talk about it because there's no benefit, I think, to anyone in like having this opacity around how the venture industry works. But I do think, and I think this is part of what you do for your clients as well, is making sure that people do their research and have a real understanding about what they're getting into, what the terms look like. There's a bunch of books and blogs now that you can read about this stuff, podcasts, obviously, like this one.
Mhm.
And so, like, do a little bit of work, right? It's beyond just, I mean, if you're investing in crypto, you're probably not just like throwing random money around. Like, you probably spend a little bit of time, you're doing some research, just picking an alternative that's essentially publicly available. Um, and you're making some decisions. Okay, I want to hold these crypto assets. Um, and you're going to want to do the same for alternatives, private equity venture, and sort of really understand, okay, this is how this industry works. This is historically what the returns have been. Here's how long should expect my money to be tied up, and then make your decisions based on that. And I think and that won't take a lot of time. It's not like this big mystery now, right? There's lots of public
Mm.
information about it, but I think being deliberate about that actually is a good thing. And I think that, like, knowing what you're getting into, right? It's not just, okay, I want to go get into some privates. Venture sounds cool, right? It's like doing just a little bit of work, right? Spend an afternoon, do some research, and be like, okay, now I know what I'm talking about. Now I'm going to call Nick and say, how do I do this?
Can it be that bare minimum too? Just like, you're taking 30 minutes of your day and just, alongside AI or alongside Google, just really trying to break into the foundational knowledge that you have to have.
Yeah, I don't think it takes that much time. Right, and again, you're
Yeah.
talking to someone who's willing to take some risks and sort of be like, "Okay, I wanna know a little bit, so I'm not like an idiot, but I don't need to know everything, I'm just gonna jump in." Sometimes when you know too much, right? And so,
Right.
yeah, but I think part of maybe what prevents people is they think, "Okay, I've gotta go, like, back to school basically and get
Mm.
a master's in venture or something like that." Like, you don't need to do that at all. Spend a little bit of time, 30 minutes might be a little bit light, but, spend some time doing some research, right? You don't even need to go to get to your computer. You can pick up your phone and talk to ChatGPT and have it teach you
Yeah.
about the venture industry, right? Listen to your podcast, listen to All In. There's some plenty of the Acquired podcast is some is VCs. There's OpenView has a great pod. There's a bunch of 20-minute VC. There's a bunch of podcasts out there, and you can listen to a little bit of that, and then you know enough to call Nick and say, okay, I'm ready to get into this
There you
asset
go.
class. How do I do it?
Amazing. Looking ahead to the future, let's say looking ahead 5 years, do you believe that more capital will move into private markets?
Well, I think let me back up from that. I'm optimistic about the United States. I'm optimistic about technology, and I'm very
Mm.
optimistic about the next like 10, 20 years, right? I'm an AI
Right.
optimist, and I'm a realist. I understand that there'll be some disruptions around AI. I don't think we know what those actually look like yet. I think we're freaking out about stuff that we don't understand. But, when I look at like AI and quantum, like these are two areas that I would point to that I think are going to be transformational to our
Mm.
world, right? In ways that we haven't even thought about yet, right? And like when I think about that, like that gets me excited. I want to stay in the game to experience and participate in that. So I would just preface everything I'm about to say with like, I think that now is a great time to be investing. Now is a great time to be a human being, right? Especially a human being in the Western world and or in the United States. So I'm super optimistic about all of that.
Yeah. We just had an episode with someone who is really deep in the tech sector of venture capital and AI really and like you mentioned also with quantum computing, I mean, we have these two huge transformative things that are coming to society at a very very early stage right now.
Yep.
Um, and it I mean, I wasn't directly a part of this. I'm a little bit younger, but it really goes back to the invention of the internet and how that gradually was implemented into society.
Yeah.
And I think we're
And
at
I think
another
that's the right
stage like
analogy,
that.
Nick. I think the last time we had something that felt like it was gonna be transformational in this way, and I actually think this might be more transformational than sort
Oh,
of
for sure.
the internet, but was definitely sort of the mid to late '90s, and that for me, that was, like, right as I was coming out of college, right? Was like,
Mm.
all of a sudden the internet was born and they all and I don't think we had any idea just how powerful that would become. And in particular, because now the internet's mobile, right? Like that wasn't even something
Oh
we were
yeah,
thinking about at the time, right? There weren't even laptops kind of way back then, right? I mean, we didn't have the ability to miniaturize compute power in the way that we do now. I mean, it's just but I think that that'll be dwarfed by what happens with AI and quantum, and that's exciting. And look, I think
yeah,
everyone should want to be a part of that in one way or another. And there's lots of ways to do that, both in the public and the private market. So I think that's these are all positive things. And then we should be users and getting up to speed on all this stuff as much as we possibly can.
for sure. Yeah, yeah. I mean, now's the time because I mean, once it's passed, and you don't want to be left behind. Um,
100%. Absolutely.
yeah. So let's look at something for our viewers here. Um, and kind of get your take on this. If you were advertising to a serious investor today, and they were looking to start building exposure to the public markets, how would you suggest that they do that? What would you say the steps would be for them to take?
Yeah. So to be a public market investor, so the first thing I'd ask them is, do you want to be a trader or an investor? Right? Or what's your allocation to those two? I don't want to talk to you about trading. That's up to, that's you and you're going to have to figure that out. I don't have lots of advice for traders. If you're going to be an investor, then I would ask if you want to be sort of an active, do research style investor or not. If you don't, if you're just like, I want exposure to the public markets, I don't want to do much work, then go buy an index fund and you'll get
Mhm.
the benefit of the public markets, whatever that average is, and you'll do fine. Right. Um, so those distinctions are important. If you're willing to do some work, then again, it goes back a little bit to like, hey, what are you excited about? Right? What are the
Yeah.
trends that you're most interested in? Because it does take a little bit of work to sort of uncover what you think are the best opportunities in the public markets. And so if you're willing to do that work, then absolutely go do that work and find, I don't know, 10, 15, 20 companies that you're excited about and put some money in those companies. And then for each company, you build a sort of heuristic around, okay, this is sort of the band that I'm a buyer in. Here's above which I feel like I want to take risk off the table based on what I know now, and you can reevaluate that. And below which I need to reevaluate my assumptions because the market is seeing something that I'm not seeing. And you might reevaluate and say the market's wrong. I'm going to double down, or you might reevaluate and say, hey, actually, there are some things I missed here, and I had a little flag to say if this stock below, falls below 20, I'm going to take a closer look at it. But I think those are good heuristics, and as long as your companies are trading in those bands, I mean, you re-underwrite sort of every quarter as the new information comes out, but I wouldn't. Again, you're not a trader, you're an investor. You're in it for the long haul. You believe in the management, you believe in the thesis, you believe in the overall opportunity. That's how I approach it.
That's amazing. Yeah. So if you're interested in building exposure outside those public markets, step one, identify what you're passionate about. Step two, find some companies that you believe resonate with that passion and those beliefs that you have, and take the steps from there. I mean, like you said, it's not going to be easy. You're going to have to do some work, but
Yeah. So, well,
the
let me give you the
reward in the
private
long
markets
run.
version of what I just said for the public markets, right? Because you had asked me about how do
Yeah.
you get into public. So, if you want to get into privates, absolutely. I think you started to say it, but I want to make sure we're super crisp about it. Like, you want to
Yeah.
get into privates, great, right? First is do a little bit of research, understand what does venture capital mean, what does private equity mean. There are different flavors of venture capital at different stages. Decide what you think is most interesting, right? Do you want to be at the very earliest stages? Do you want to support growth companies? How do you want to think about that? Do some research based on your own network, right? Who you bank with, what platforms you have access to, whether you're a client yet of Nick's, things like that. How do I get access to those things, right? And then once you get on one of those platforms, then you can start doing research on the underlying managers. Start with areas that you're excited about. I'm super interested in whatever quantum computing, so I'm going to go try to find some funds that are, in particular investing in quantum. And then go try to map thesis to manager, people who have a real background in what you're trying to do.
That's awesome. I mean, they can't get much more simple than that. I mean, you just got the roadmap directly from Seth Levine. I mean, that's you should write a book about that or something.
I should write a book about that,
That's a joke
actually. Yeah.
because that's a joke because Seth actually has a really great book that's out. I just wanted to give you an opportunity to tell the people about that.
Yeah, appreciate that, Nick. So if you've enjoyed this conversation, the book's not about investing. It's about the
Sure.
future of capitalism, right? So pretty important topic these days. It's a bit of a defense of capitalism, but also talks about the ways that capitalism is and is not working and how we might change it a little bit. It's called Capital Evolution. It's actually a bestseller. We released it just about a month ago, as we're talking, a little over a month ago as we're talking. And I would encourage people to take a look, right? I mean, it's an interesting and very, I think we try to write it to be very accessible. We tell lots of stories. Got to interview some really interesting people. Got Jamie Dimon, on the phone for 45 minutes. Dan Schulman, who's the new CEO of Verizon, was the CEO of PayPal when we talked to him. Bunch of other people at Hobby Lobby, people at Patagonia, Lisa Green Hall, who basically invented impact investing, Larry Fink from BlackRock. Like, we got to talk to some really interesting people. We tell their stories in the book, and then we sort of describe what's going on, describe the research around that, but in a way that is, hopefully well written, but very accessible to readers. We've gotten a lot of really positive feedback. Capital Evolution. You can find it on Amazon. You can find it at thecapitalevolution.com. And there's a bunch of you'll probably find it at your local bookstore as well.
There you go. That sounds incredible. And yeah, if you want more nuggets of knowledge from Seth, I think that's a great opportunity. This conversation has been incredibly insightful, Seth. For listeners who want to learn more about what you're building, um, who want to explore private investing more seriously, where should they go? How can they find out about you? Give us everything we need to give us the bullet points
Yeah,
there.
so 3 websites for me. One is the one I just gave you, thecapitalevolution.com. The second is my personal blog. I'm not super active on it because I've been writing a lot of book stuff, but sethlevine.com. There's ways to reach me there. And then my firm is Foundry, and our website is foundry.vc. We're not open to individual investors. We're not raising any more funds, but you can find more information about what we do there. And I would particularly point you towards some of the podcasts we've mentioned here, right? This podcast and others. And then also the blogs of people like my partner, Brad Feld at Feld.com, or Fred Wilson, AVC. There's a ton of really good content out there by venture capitalists. And I would encourage you, and of course there's VC Twitter, or VCX, I guess we should call it now. There's lots of places to get information. Go spend an afternoon poking around, right? It doesn't take a lot of time, and there's a lot of fun content out there.
Amazing. And for any operators, I know you said you're not looking for individual investors, but for any operators out there looking to participate in a deal like yours, what are you actively looking for right now?
Yeah, so I mean, we're still making new investments. We're still pretty active. We do a lot in marketplace. We do a lot of like vertical AI. We do a lot of companies that are like create technology that like a CIO, CTO would buy. We do some consumer. We were the big investors in Fitbit. We're in Whoop now. A bunch of others, SeatGeek, which is both consumer and marketplace, which is nice. And you can see all the list of all of our companies on our website. My emails all over our website, so you can find me there, and feel free to reach out. I respond to all my emails that are written actually to me. I don't respond to the blind copies, but I respond to all of the ones that are actually sent to me. And so,
There you go.
we see thousands of investment opportunities. We only do a few a year. So just kind of preface with that, but I'm always happy to give people feedback as well.
Sounds great. Seth, been an absolute pleasure to have you on today. Really appreciate you sharing your experience, your knowledge, your insights with us. Um, Thank you again for being here today. Any last words of advice for our listeners? Any quote you would like to be remembered by that you'd like to leave with us?
First, thanks for having me, Nick. I think this has been really fun. I love talking about this stuff, right? And I am psyched that people are interested in this asset space. And so what I would leave you with is, be curious, right? Everything good comes out of curiosity. And so I think that I would encourage people who are interested in this or whatever else you're interested in to like really lean in. We live in a time when there's so much available information, and like there's never been a better time to be a curious person.
I couldn't have said it better myself. I love that. Be curious. We're looking to educate people. Everybody, Seth Levine, thank you again so much for giving us this great opportunity. Check out his new book, check out his website, hit him up if you have any questions, and we'll come back with some more experts in the alternative asset field. Seth, thanks again for your time and great to meet you.
Thanks, Nick. Be good, everyone.